After months of escalating tension, the US and China have finally reached a new trade and technology agreement, setting the stage for what could be a massive rally when markets open Monday. Investors are already celebrating the deal, which aims to ease tariffs, improve supply chain cooperation, and reopen certain tech exports. Futures are flashing green, and analysts expect one of the strongest openings of 2025. But beneath the euphoria lies a warning. This rally is built on FOMO, not fundamentals, and the same forces pushing stocks higher could send them crashing just as fast. The deal that sparked the rally. According to early reports, the US and China agreed to partially roll back the most punitive tariffs imposed over the past 2 years. Tech companies will regain limited access to critical semiconductor exports, while agricultural and consumer goods tariffs will be reviewed. The news has triggered instant optimism. Asian markets jumped overnight, and S&P 500 futures surged in pre-market trading. Analysts predict that tech, manufacturing, and logistics sectors could lead the rally, with semiconductor and EV-related stocks seeing double-digit gains early in the week. This deal has been seen as a symbolic victory for global stability, signaling that both countries want to prevent further economic damage. For short-term traders, it's a dream setup, positive headlines, momentum, and relief after months of uncertainty. But beneath the surface, a dangerous setup. Here's the catch. Markets were already priced for perfection. Stocks have been rising non-stop for months on AI hype, liquidity illusions, and pure investor greed. The recent rally has stretched valuations to extremes not seen since 1999. That means Monday's surge could push markets into the final, most dangerous phase of a blow-off top, the euphoric climax before a sharp correction. When investors chase prices out of fear of missing out, volatility spikes and reversals come out of nowhere. Corporate earnings aren't growing fast enough to justify current prices, and credit conditions continue to tighten. Even as stocks rise, liquidity is drying up, government debt issuance is ballooning, and households are struggling with inflation and debt. The mechanics of a FOMO market. A FOMO-driven market has one rule: buy first, think later. Retail investors, hedge funds, and even pension funds are piling into mega-cap tech stocks, ETFs, and speculative names without regard for risk. This behavior amplifies price momentum, but it also creates fragility. When the next negative headline hits, whether it's disappointing earnings, a central bank warning, or renewed geopolitical tension, selling pressure can snowball. Remember, the same traders buying on emotion today will panic sell tomorrow. That's how sharp corrections start. Why the drop could be bigger than expected? There's another reason for caution: positioning. Hedge funds are heavily leveraged, and institutional investors have raised exposure to near-record levels. That leaves almost no cash on the sidelines to support prices if markets start falling. Meanwhile, central banks are still tightening financial conditions. The Federal Reserve hasn't committed to rate cuts, and bond yields remain elevated. That means the fuel that powered the last rally, cheap money, is gone. Once the excitement fades and reality returns, markets could face a swift 10 to 15% pullback. The smart investors move. Traders may enjoy the fireworks Monday, but smart investors will use the rally to reduce exposure, take profits, and build cash. When everyone else is buying, discipline is the real edge. The next few weeks will separate those who understand the difference between momentum and madness. History has shown time and again that euphoria is the final stage before correction. So yes, Monday could be a celebration. But when the music stops, only those sitting on cash will still be dancing. If you found this analysis helpful, hit like, subscribe to Financial Vlog, and turn on notifications so you never miss breaking updates on the markets, economy, and global finance.